let's walk through both of the income methods to determine loan amounts. And if you need to make some adjustments to what you've developed, that's fine. Let's get started. In the example, begin with annual earnings for taxes, average of 3 years. So we're going to take the last 3 years, equals average, and highlight the 3 and closing parentheses, and it gives us the average. So we know we're starting with that. And then it says add owner income. And you add the owner income for the most recent year, unless it's really out of line, and then you'd average that as well. But in our case, we're just going to equals this amount, and we're going to add owner income. Then in line 3, it says subtract unpaid expenses, payroll, etc. So unpaid expenses equals our current total minus this one. And then it says subtract existing depreciation equals our new current total minus depreciation. Then we're going to subtract one-time only income because the owner would keep that. So that takes it down to $70,843. And now we're going to multiply to determine the value. And I have 3 to 5. Well, I'm going to make it easy for you, so just 3. So this current value, or the current amount, times 3. Widen that so you can see it. So the value of the business is $212,530. Now let's take a look at the free cash flow method. And I've taken the information here and I've added it over here as needed. So we start off with $96,000. And the length of the loan is 5 years, which is 60 months. So that puts our free cash flow, so the total involved, as $480,000. So then we're going to take our down payment away because we wouldn't need to include that. We're going to already have that ourselves. And that puts us at $415,000. Now, the owner expects a 10% return on their down payment. So that means they're going to place a value of that money of 15%, or excuse me, of 20% per year. So that means it's $65,000 times 20%, and that's 13, but it's per year. So times 5, because it's going to run for 5 years. And I did that to make the math easy for you. So in 5 years, the owner expects that $65,000 return on investment. So they should be able to bring in enough money to make it worthwhile to have made that down payment. So now we look at that return on investment, and we want to take that away. So equals $415 minus that expected return. So that gives us the amount available to make payments is $350,000. And since it's 5 years, we're going to divide that by 5. That gives us the annual amount. So we have $70,000 available to make payments with. So in order to determine what that would be per month, we're going to say divided by 12. So $833.33. By the way, just to let you know, if you do actually plan to purchase a business, I strongly encourage you to go through a realtor. They're going to get a lot more accurate with these numbers. They know all of the hidden areas that you need to take into consideration. This is just to start getting a ballpark figure. That's all it's meant for. You do want to work with professionals if this is something you're going to be doing. This is a major investment and you don't want to make mistakes. Anyway, so we have $5,833.33 to work with. So now we're going to start doing some math. We're going to figure out how much our monthly payment would be at 8% and how much it would be at 10%. I'm going to delete that column so we can go wider here. And then we're going to figure out the total amount of the loans, and then we're going to drop in the principal amount and the total purchase price. So let's go ahead and do that. We click on the FX and we bring up payment, and it automatically helps us. So in this case, our first rate is 8%, and there's going to be 12 payments, so /12. And how many months? Well, in this case, we're going to have 60. It's nice when you enter the numbers themselves into cells. That way, if you were wanting to determine maybe a 4-year loan or something like that, you would just change this one figure and would automatically be able to recalculate. The present value of the loan is what we're going to be determining. And there's a nice complicated algebraic equation that you can use to determine this, but it's a heck of a lot easier just to drop in some numbers until you get to where you need to be. So we're going to do it that way just for this exercise. The future value is 0, so you're going to be paying it off and you're not going to worry about the type. So coming back to the present value, you know it's going to be at least $250,000. So that puts us at $5,069. So we're not there yet. Let's see, 560,000 or 260,000. That puts us at 52. What about 7? 5, 4. Okay, 5, 7, 5, 7, 2, 28. 5, 6. What about 3, 0? Nope, that's too high. 2, 9. 2, 8. Okay, so it looks like it's 8, 9. 58, 59, 57. See, this is still, for me, this is still faster than algebra. If you want the algebraic equation, you can go into Google and look up amortized house payment calculation. Anyway, 5819 is below 5833, so we are good. And that way we know our loan amount is $287,000. So I can say 287,000, and I can say the total purchase price is equals this times 60. So our total purchase price, $349,159.51. So our rate is 10% divided by 12. Our periods are 60. Our future value is 0. And our present value is, well, we know the other one was 287. So let's say 287. We'll start there. Oh, that's too high when it's at 10%. So we're going to say 270. 57, we still have a ways to get up. 20, let's see, 280, that's too much. 75, 5842, I think that's going to be as close as we get, but let's try 5864, yep. And you can tweak the smaller numbers to get more exact, but that's the 3 digits is fine. So you're going to be able to borrow $274 at the 10%. So you definitely have less buying power. And then this times 60 is the total amount of our loan. So we're going to pay back a little bit more, but we're going to have less buying power. So that's what you're looking for as far as the numbers are concerned. Let me know if you have questions.